Hey there, deep divers. If you're plugged into the financial world at all these days, you're probably hearing a lot about this crazy market boom.
Yep.
Seems like every headline is screaming about record highs and Bitcoin, and
Oh, yeah.
everybody's an investing guru all of a sudden. It's exciting stuff, but
It is exciting.
have you ever stopped and wondered if it's maybe a little too good to be true?
Right.
Well, that's exactly what we're diving into today. We're going to go on a deep dive, exploring those risks that might be simmering underneath this seemingly unstoppable market surge.
Yeah. It's like a roller coaster.
Oh,
That climb is exhilarating, and the view from the top is amazing.
oh yeah.
But there's always that moment, where, the drop is coming. And the
Right.
bigger the climb, the steeper the drop.
That's a great analogy. And speaking of roller coasters, we are going to take a trip back in time today, exploring some historical examples of financial booms and busts.
Yeah.
Because history has this uncanny way of repeating itself. And by understanding how things played out in the past, we might just get some valuable insights into what the future holds for us.
For sure.
And hey, don't worry, we're not just going to leave you hanging on the edge of your seat.
No.
We'll also be looking at some practical advice for navigating this potentially volatile landscape.
Exactly. Knowledge is power, as they say.
Oh, definitely.
And one of the things we need to be aware of right off the bat is the elephant in the room,
Okay.
the U.S. national debt.
Right.
Currently, it's hovering around a mind-boggling $36 trillion.
36 trillion. That's a number so big it's hard to wrap your head around.
It is.
What does that kind of debt actually mean for us in practical terms?
Well, for starters, it means that a significant chunk of the government's budget is going towards simply paying interest on that debt.
Oh,
As interest rates rise, that burden gets heavier, leaving less money for other crucial things like infrastructure and education.
so it's not just an abstract number. It has very real consequences for all of us.
It does.
Okay, so we've got this massive debt looming overhead and a market that seems to be defying gravity.
Yeah.
Where do these historical examples come in? What can we learn from the past?
Well, one of the most striking parallels, I think, to today's situation is the Roaring '20s.
Okay.
Think flapper dresses and jazz music and just an overall sense of unbridled optimism.
A lot of parties.
Yeah, a lot of parties, but it was also a time of easy credit and rampant speculation.
So it sounds a little bit like today with everyone jumping into the market hoping to get rich quick.
The similarities are definitely there.
Yeah.
People were borrowing heavily to invest, driving up stock prices to really unsustainable levels.
Yeah.
It was a classic bubble waiting to burst.
Uh-oh.
And in October 1929, it did. The stock market crashed, wiping out fortunes and triggering the Great Depression,
Wow.
a devastating period that had a profound impact on the world for decades to come.
So basically history is telling us to be wary of exuberance and easy money.
Yeah, I think that's a good lesson to take away.
Got it. But surely the Roaring '20s isn't the only example we can learn from, right?
Absolutely not.
Yeah.
Let's fast forward a few decades and look at Japan in the 1980s. After World War II, Japan experienced this economic miracle
Okay.
fueled by government intervention and low interest rates.
That sounds familiar.
Right. Easy loans led to a surge in asset prices, particularly real estate and stocks.
Okay.
There's another classic bubble. And when it burst in the early 1990s, Japan entered a prolonged period of economic stagnation.
Oh, wow.
It's known as the lost decades, and they're still grappling with the consequences of that bubble today.
Okay, so we've got two historical examples of booms turning to busts, both fueled by easy money and this sense of euphoria.
Right.
But let's bring things a little closer to home.
Okay.
What about the more recent tech stock surge of 2021? That was kind of a mini bubble, right?
It certainly had all the hallmarks of a bubble.
Okay,
Remember
right.
those pandemic-era stimulus checks and the historically low interest rates? Well, investors found themselves with a lot of extra cash. They poured it into tech stocks, and prices soared to levels that seemed completely disconnected from reality.
It seemed like every other person I met was suddenly a day trader,
I hear you.
making a killing on tech stocks.
It felt like easy money at the time.
Yeah.
But then reality set in.
Oh.
As inflation started to rise and the Federal Reserve hinted at raising interest rates, investors got nervous.
Okay.
The tech-heavy NASDAQ index plunged and wiped out trillions of dollars in market value.
Oh, wow.
It was a stark reminder that even in the age of digital disruption, the fundamental laws of economics still apply.
Yeah.
What goes up must eventually come down.
So we've taken this whirlwind tour of financial history,
Yeah.
and the message is pretty clear. Bubbles are a recurring phenomenon, and they can have devastating consequences.
Yeah.
But what makes this time any different? Is there something about this current market boom that suggests it could be heading for a similar fate?
That's the million-dollar question, isn't it? To answer it, we need to take a closer look at what's happening right now and identify the potential danger signs. Are there any red flags waving in our faces? Are we seeing echoes of those historical bubbles in today's market?
Okay, I'm officially hooked. Let's dive into those danger signs.
Welcome back to our deep dive.
So we've talked about the warning signs and the historical parallels, but I want to know what our listeners can actually do
Right.
to navigate this crazy, volatile financial landscape.
Yeah, because feeling empowered is way better than feeling overwhelmed.
Right.
Let's break it down.
Perfect. First up, let's talk real estate.
Jack.
A lot of people see property as a safe haven, especially with inflation. What are your thoughts?
Real estate can definitely act as a hedge against inflation. Historically, property values tend to rise over time.
Okay.
And as inflation eats away at the value of money, your mortgage debt effectively becomes cheaper.
So inflation can actually work in your favor if you have a mortgage. That's interesting.
Yeah, in a way.
I imagine it's not as simple as just running out and buying any house, though, right?
No, you're absolutely right.
Right.
It's crucial to remember that real estate isn't a guaranteed win.
Hey.
You have to consider the regional market conditions.
Right.
What's happening in your specific city or town? Is there a strong demand? Are prices already inflated?
Right.
It's all about location, location, location.
So don't just jump in because you heard it was a good investment.
Right.
Do your research.
Exactly. Treat it like any other major financial decision. Research, analyze, and proceed with caution.
Noted. Now let's move on to something that always seems to come up when people talk about economic uncertainty. Precious metals.
Okay.
Gold, silver. Are these actually safe havens or just shiny distraction?
Precious metals, especially gold, have kind of earned their reputation as a store of value during times of crisis.
Okay.
They're tangible assets,
Mm.
not subject to the whims of governments or central banks.
Right.
And they tend to hold their value pretty well during periods of inflation.
So if the dollar takes a hit, gold could rise?
That's the general idea. But of course, like with any investment, there are risks involved. The price of gold can fluctuate,
Right.
and it doesn't generate any income on its own.
So it's more about preservation of wealth than rapid growth.
Yeah, that's a good way to think about it. Gold can be a valuable part of a diversified portfolio, but it's not a get-rich-quick scheme.
Speaking of diversification, what about ETFs? They seem to be all the rage these days.
Yeah.
Can you give us the rundown? What are they and why might they be a good option now?
Sure, ETFs, or exchange-traded funds, are basically baskets of stocks
Okay.
that track a specific index like the S&P 500.
Right.
They offer instant diversification because you're buying a small piece of many different companies.
So instead of putting all your eggs in one basket, you're spreading them out.
Exactly. And that can help reduce risk. If one company in the ETF underperforms, it's less likely to have a huge impact on your overall investment.
That makes a lot of sense. So we've talked about real estate, precious metals, and ETFs. What about individual stocks? Are there any strategies for picking stocks that might be more resilient during uncertain times?
Well, this is where things get a bit more challenging.
Mm.
Picking stocks is inherently risky,
Right.
and trying to time the market is almost impossible.
So basically, don't try to be a day trader.
It's not as easy as it looks on social media.
Okay.
However, if you're determined to invest in individual stocks,
Yeah.
there are a couple things to keep in mind.
Okay.
First, avoid chasing the hottest trends.
All right.
Just because the stock is going up doesn't mean it's going to keep going up.
All right.
Focus on companies with strong fundamentals, solid financials, a proven track record, a competitive advantage in their industry.
So do your research. Don't buy into the hype.
Precisely. And second, be patient.
Yeah.
Don't expect to get rich overnight.
Okay.
Investing is a long game.
Right.
If you believe in a company and its long-term prospects, be prepared to hold on to those shares even if there are short-term fluctuations.
So it's more of a marathon than a sprint.
Exactly.
Yeah.
Remember, investing shouldn't feel like gambling.
Right.
It's about building wealth gradually over time.
That's great advice. And one of the biggest takeaways for me from our conversation today is the importance of financial education.
Oh, absolutely.
No matter what investments you choose,
Right.
you need to understand the risks and rewards and have a plan.
I couldn't agree more. Financial literacy is absolutely essential, especially in today's world.
Yeah.
There are so many resources available,
Yeah.
books, websites, podcasts.
Like this one.
Ah.
But seriously, I think it's important for people to feel empowered to take control of their finances
Absolutely.
and not just blindly follow the crowd.
The more you understand how these economic sources work,
Right.
the better equipped you'll be to make smart decisions.
Okay, so we've covered some specific investment strategies for navigating a potentially volatile market.
Yeah,
But the theme here is education and awareness.
for sure.
Do your research, stay informed, and don't be afraid to ask for help.
That's right.
Yeah.
Remember, it's your money, your future. Take control of it.
I love that. Okay, deep divers, that brings us to the end of part 2 of our exploration.
Okay.
But we're not done yet. In part 3, we'll be wrapping things up with a thought-provoking question
Okay.
that will hopefully leave you pondering the bigger picture. Stay tuned. Welcome back, deep divers. We're in the final stretch now of our exploration into this market boom. We've uncovered the potential risks, explored historical parallels, and even equipped ourselves with some advice on how to navigate this uncertain financial terrain. But I want to shift gears a bit now and ponder a bigger question, one that goes beyond just protecting our investments.
Yeah.
If we zoom out and look at the bigger picture, the question we should be asking is, what lessons can we learn from history
Right.
to create a more stable and equitable financial future for everybody, even if this does turn out to be another bubble?
You know, it's not just about individual wins and losses. It's about building a system that's more resilient and less prone to those dramatic boom and bust cycles.
Exactly, because the fallout from these bubbles doesn't just affect investors.
It doesn't. It impacts the entire economy. And often it's the most vulnerable among us who bear the brunt of the consequences.
Right. So if history is trying to teach us something here, what is it? What are some key takeaways to help us build a more sustainable future?
One of the most glaring lessons, and we've seen this happen over and over again, is the danger of excessive debt.
Okay.
You know, from the Great Depression to the Japanese asset bubble to the more recent tech stock surge, unsustainable debt levels create these fragile systems,
Right.
and they're ripe for collapse.
So we need to be more responsible with how we manage debt, both personally and as a country.
Absolutely. Promoting financial literacy, encouraging responsible lending practices, and implementing policies that prioritize long-term sustainability over short-term gains are some crucial steps in the right direction.
It's like taking a more holistic approach to financial health, both for ourselves and as a society.
Exactly. Shifting the focus from quick profits to a more stable and sustainable growth model.
Now, another takeaway that comes to mind is the importance of greater regulation and oversight of the financial system.
Oh, for sure. The 2008 financial crisis was a stark reminder of what can happen when markets are left unchecked.
Right.
Unrestrained speculation and risky behavior can really spiral out of control, creating these systemic risks that threaten the stability of the entire economy.
So it's not about stifling innovation or preventing people from investing, but rather about establishing safeguards
Yeah,
to protect the system as a whole.
absolutely.
Finding that balance between encouraging economic growth and ensuring that growth is both sustainable and equitable.
Right. We need to learn from the mistakes of the past and work towards creating a financial system that benefits everyone, not just a select few.
So as we wrap up our deep dive today, it seems like the biggest takeaway is this.
Yes,
The current market boom offers opportunities,
for sure.
but we need to proceed with caution and be mindful of the potential risks. But even more importantly, we need to look beyond our own portfolios and engage in a broader conversation about how we can create a more stable and equitable financial future for everyone.
Well said. It's a conversation that needs to continue, and it's a responsibility that we all share.
That's right. Keep exploring, keep learning, and keep asking those tough questions. And hey, if you have any thoughts or insights on this topic, we'd love to hear from you. Thanks for joining us on this deep dive. Until next time.